Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined by Managing Director and Head of Fixed Income Research, Tom Tzitzouris. Tom, how are you doing this morning?
Doing great, and it's a pleasure to be here.
Pleasure to have you. As always, a lot of interesting things to talk about. I think one of the places I want to start as we head into a new year, we're putting a wrap on 2023, is the market now expects a handful of rate cuts in 2024 and including several in the first half of the year. So first, do you think that's likely to happen? And then second, is that bearish or bullish if the Fed is cutting rates in the first half of 2024?
Yeah, well, these are tremendous questions because to be perfectly honest with you, I do not believe the economic data, particularly the inflation data, is going to justify rate cuts in the first half of next year. I think at best we're looking at headline inflation coming down to about maybe a 2.5%, which would suggest that the Fed still hasn't met its inflation target, and with wages still somewhere around 4%. So that would tell us that the inertia would be higher for inflation. I think what's happening here is very bluntly, the Federal Reserve has become the most politicized it's been in my professional career. And you're seeing investors making decisions based on what they believe is going to be very intense political pressure on the Fed in 2024 to cut. And so what that means is you very likely could see rate cuts in the first half of the year, but I don't think the data is going to justify it. Now, to answer the second question, would this be bullish or bearish for, let's say, risk assets, equities? Well, traditionally, once the Fed starts to cut, it's a sign that something is drastically wrong in the economy. But if the Fed is cutting because of political pressures and is cutting because simply and is cutting in consistent with an economy that is still fairly close to full employment, then that very likely would be bullish for risk assets. So this is a very difficult question to answer. And I think the politics are really going to cloud the investment outlook over the next 12 months. Now, with that said, we do know that the economy does appear to be slowing. We also know that the labor market does appear to be building up some slack. We saw today in today's ADP jobs report suggesting that there's been a material slowdown in job gains. So that's important to note. So there is a slowdown coming. And that does suggest that inflation data should also continue to migrate closer to Fed target. I just don't think we're going to be there, at least by March, though.
Right. Yeah, that's a pretty aggressive timeline to shift so aggressively from what was a pretty hawkish Fed not all that long ago, higher for longer, concerned about inflation. Do you think that they've shifted concerns from inflation to recession at this point? You know, the 10-year yield has dropped pretty precipitously. It's been met with, enthusiasm in the stock market, but at some point, doesn't that dip in long-term yields, rather than be risk on, start to be a harbinger of weakness in the economy and maybe more reflective of the slowdowns that we're seeing in the job market?
Well, I do think that that's true. That part of the reason why we've seen 10-year yields drop by 80 basis points, going on 85 basis points at this point, is because there has been a material slowdown in the job market. So the bond market is right to price in, at the very least, a soft landing and begin to migrate towards something deeper than a soft landing, such as a recession. I don't think that the Fed, at least from Jerome Powell's public words, has shifted its focus away from inflation. In fact, Jerome Powell said quite clearly a week or so ago that they're still concerned about the inflation dynamics in the U.S. economy. So publicly, the Fed is communicating that they're still more concerned about inflation than an economic slowdown. But I think privately, there's probably going to be some chatter inside the Fed indicating that a slowdown is coming and that a transition towards focus on labor markets is in order. When that transition happens publicly at the Fed is anybody's guess. My suspicion is that as long as inflation is close to 3%, that transition should not happen. That is, the Fed should continue to focus on inflation with inflation at or above 3%. So that inflation data is going to be absolutely critical. And I do think the other key point here is that one of the reasons why Treasury yields have been dropping is because the Treasury itself has shifted its focus from issuing longer on the curve to issuing a larger percentage on the front end of the curve, that is bills. The significance of that is that allows for the Treasury to not only not drain liquidity from the broader financial markets, but actually use a backdoor tool called the Treasury General Account to inject liquidity into the economy by withdrawing liquidity or funds from the Fed's reverse repo facility and then pushing it back out to the market. So there has been a stealthy liquidity injection from the Treasury, which is countering the Fed's own financial tightening. And that's important because that means that the Fed's job has gotten harder at fighting inflation. It has not gotten easier with this slowdown in inflation because financial conditions are easing ahead of an economic slowdown. So that's important. So a lot going on here, and no surprise, it's been pretty much an everything rally since the beginning of November as a consequence of these tools and these patterns.
Right. Yeah. November, not just a great month for stocks, but also for fixed income as well. One of the best 60-40 months in a long time. Well, as you mentioned, a lot going on heading into year end. We'll certainly hope to talk to you again at the beginning of next year to get our hands around everything. But Tom, I want to thank you as always for the time.
Yep. My pleasure.